Gas prices are hitting record high almost daily, causing financial pain at the pump for millions of people across the globe. What's behind the price spike? Is the cancellation of Keystone XL pipeline, the supply disruption from COVID-19, or is it a Russia's invasion to Ukraine? And who's to blame? Consumers are also wondering when they might see some relief. Hi, my name is Gio. Hope you're doing well. In today's episode, I'm gonna try to answer all these questions. Let's get right into it. The world is facing an energy crisis based on the price of a gas and struggle to recover from the pandemic. Consistent rises in wholesale gas price have made utility unprofitable with no ability to pass cost on, and huge shortages have placed increasing demand on energy infrastructure. High gas prices are created in large part by high crude oil prices. Oil cost accounts for 43% of the price of regular gasoline. The remaining 57% comes from distributions, marketing, refinery, and taxes. When oil prices rise, you can also expect to see the price of gas actually rise at the pump. A $10 rise in oil price per barrel translates to a 0.25 cents increase in gas price per gallon over the long term. Traders of commodities such as gasoline, wheat, and gold also cause high gas price. They buy oil and gasoline on the commodities future market. These markets allow companies to buy contracts of gasoline for future delivery at an agreed upon price, but most traders have no intention of taking ownership. Instead, they plan to sell the contracts for a profit. Both gas and oil prices are affected by the ups and downs in this future contract. The price depends on what buyers think the price of a gas or oil will be in the future. When traders think that gas or oil prices will be high, they often beat them up even higher. Normally, that occurs in the spring as traders start buying oil future contracts in anticipation of summer prices rise. Gas and oil prices also rise when the value of US dollar declines. The cost of oil has steadily increased since last fall, when it was around $70 a barrel, to more than $130 at the beginning of March, before settling back at around $100 a barrel on March 15. That had been reduced by COVID-19 pandemic. That initial jump in the cost of crude oil was driven by ongoing economic recovery, which boosted demand by consumer and businesses that had been reduced by COVID-19 pandemic. Gasoline prices rise and fall with the price of crude oil, though not always in sync or to the same degree. Oil is a global commodity, and its price is determined primarily by global supply and demand. When supply is greater than demand, prices fall. Conversely, when demand is greater than supply, prices are higher. Since supply and demand have the greatest influence of the price of oil, what role did the cancellation of Keystone XL pipeline play in the recent spike in oil and gasoline prices? The Keystone XL pipeline, owned by Canadian company TC Energy Corp and the government of Alberta, was the fourth stage of Keystone project. KXL was supposed to run from Alberta, Canada, through Montana, South Dakota to Nebraska. The KSL would have transported 830,000 barrels per day of heavy oil and crude oil. From there, existing pipelines will carry the oil to points in the US, including refinery in the Gulf South. Was the KSL cancellation a contribution factor in the recent spike in oil and gasoline? Many experts say that canceling the pipeline had little effect on the current price of a gas, despite several false claims on social media, including how railroads would greatly benefit. Very little crude oil is transported by rail because it is more expensive than pipeline. Transporting oil via rail has been and continues to be a method of last resort. According to a Reuters fact check in 2019, the US imported 3.7 million barrels per day from Canada. However, only 8%, which means 110 million barrels, were by rail. If not by rail, then how will the US make up for the KXL cancellation? According to several experts, the existing Keystone pipeline has plenty of excess capacity to handle the increased volume of oil from Canada. As a side note, Canada is the largest foreign supplies of crude oil to the US. In short, the effect of these actions on rising rising gasoline prices is negligible. The chain of events begin with the pandemic and the fall in wholesale energy prices that came with it. As COVID-19 hit, gas and electricity use fell drastically across countries, and when met with overproduction from oil and gas companies, prices crashed. When demand for gas and oil plunged during the pandemic, OPEC, which is the Organization of Petroleum Exporting Countries, and oil-producing nations such as Russia cut production, reducing it by 10 million barrels. To put that in perspective, that represents 10% of the global supply. As gas supply fell and demand started recovering, wholesale prices began to rise. This continued past pre-pandemic prices, reaching a new high level in the last few weeks. Going from record low to record high has led forward contracts to almost double the price over the past year. Even though the global supply of oil may have declined during COVID-19, demand was reduced as people were afraid to travel. This kept oil and gasoline prices low. As the world began to recover from the pandemic, demand increased. With demand rising, gas prices also started to increase. By March 2021, an increase of 45% from its pandemic low. Russia's invasion of Ukraine and a global reaction to it stand to make the situation even worse, including sending gas prices to a new all-time high. The conflict has shaken global market, causing stock market turbulence and sending oil prices higher and causing even more uncertainty in an unstable worldwide economy. It's also creating concern that inflation already running high could run even higher. In the United States, the Consumer Price Index, which measured the average change in price consumers pay for goods and services, was up by 7.5% over the past year in January. That's a 40-year high. The hope was that inflation will soon start to come down and that factors driving it, such as high gas prices and supply chain, would finally pass. Now it appears that the situation will be quite the opposite. What we are seeing is essentially an energy price shock and a financial market shock that come on the back of this already concerning inflation environment, an environment in which global supply chains are already stressed and in which there is already some degree of uncertainty as to the outlook. Russia is one of the biggest oil and gas producers in the world, and any disruption will have a major impact on the price. Disruptions we are already seeing. On Tuesday, President Joe Biden announced that US would ban import of Russia's oil, natural gas and coal. The United Kingdom has said it will ban Russia's oil imports as well. These moves caused a spike in oil price, which have already been in the rise, and the situation is sure to have a ripple effect across the global economy. While the US purchased only 3.3% of its crude oil from Russia in 2021 and around 7% of its total petroleum products in 2020, oil is ultimately priced by the highly interconnected global commodities market. That means rising oil prices are reflected at the pump worldwide, not just in countries that import Russia's energy. The loss of these supplies sent the crude oil price to near $140 per barrel in early March, a level not seen since 2008. While oil prices have retreated to around $100, consumers may not experience immediate relief, as experts expect price to the pump to remain elevated through the summer. Gas prices matter not just for people filling the tank of their cars, but also because of shipping and transportation. The conflict could also translate to high diesel price and yet fuel for airplanes. The bottom line is, demand in much of the world is returning to normal as the pandemic subsided. If Russia continues its aggression against Ukraine, oil prices will likely remain high. If the economic sanctions are successfully and hurt the Russian economy as it expected, Putin may be forced to withdraw. In any event, when Russia decided to be a good neighborhood, which may never happen, the price of oil should decline and the price we pay for gas should follow. This recent spike is the culmination of many issues, with Russia's aggression at the top of the list. How can we reduce the price? The most immediate thing we can do is to reduce our usage of gas by driving less or increasing fuel efficiency. One easy way to improve fuel efficiency is to keep tires inflated. Keeping the engine properly tuned can improve a car's gas mileage by 4%, or you can use public transit. In the long term, we can change our needs for oil and gas by switching to alternative fuel vehicles. Could these actions reduce the high price of a gas? Maybe, if they are sustainable over a long period of time. Thank you so much for watching. If you like the content, smash that like button, subscribe to my channel, turn on the notification bell, and don't forget to check out all the links in the description down below. See you in the next video.